Well, let's welcome in Manishi Raychaudhuri, Chief Executive Officer, Emmer Capital Partners. Manishi, good to have you here. Thanks very much, as always, for your time. Manish Chokani said, and I think it's a general feeling, right? Just look at the price action here. The market wants to go up. You can feel it. But there aren't enough triggers, I guess. And of course, I mean, there's a problem of valuations and single-digit earnings growth, etc. as well. But what's your sense, Manishi? Markets, I mean, I'm talking about India here, over the next few months.
What you said almost hits the nail on the head. You know, it's the situation right now is that valuations are, I mean, they have no doubt declined over the last 6 to 7 months, but not really as cheap as investors would like them to be. And at the same time, the bigger concern is that earnings growth, earnings estimates are still declining. You know, in fact, there was a small uptick to the consensus EPS estimates for both year 25 and year 26. But when the present earnings season, the result declaration season started from the first week of April, they have the earnings estimates have started declining again. And I think that for India, rather than the global noise that we are seeing, is possibly a bigger concern. And, and that's why I said just about a couple of weeks ago that I think Indian investors would have to wait. They have to brace for another leg down during this earnings season. At the same time, if one looks at the long term, India is clearly better placed than many of the Asian peers. After all, a 10% tariff is better than 26% of tariff. And at the same time, as a consequence of this global reshaping of the supply chains, that's kind of inevitable now. We will almost certainly see more of what Apple has been trying to do. So it is over the long term, not so dismal a picture, but in the near term, we have to brace for more valuation correction and more earnings estimate decline.
Okay, so earnings will continue to be a reality check. Got that point. Manishi, just give us 1 second. I wanted to look at two stocks, JBM Auto and Electra Green Tech. Nice surge on both of these, 4.5% to about 7% on JBM right now. Electra is up about 4.5%. There's some buzz about a large order, electric bus order, could be as big as 10,000 crores. And of course, these companies manufacture e-buses. They're part of the supply chain. So perhaps there's some excitement on who gets the win, if they get it, if Tata Motors gets it. So worth putting that out. But Manishi, to get back to the point that you're making, that earnings continues to be maybe our Achilles heel. But isn't the fact that the fourth quarter is also sort of, it's going to be maybe muted, maybe not as bad as Q3, isn't that already in the price? And what are the numbers that you have in mind? I mean, how will we end Q4? The projections for next year talk about maybe, 10 to 11% earnings growth. Do you think that will actually happen?
10 to 11% for next year, which is fiscal 26, is kind of reasonable. But many of the earnings growth estimates that I'm seeing from consensus, if you look at Bloomberg or FactSet, they're actually in the mid-teens even now. They're in the 15, 16, 17% range. And I think those estimates will have to come down. Which are the sectors that would suffer? I think, consumers, particularly consumer staples, these companies are constantly, in each and every quarter, they're postponing their turnaround target. I hear analysts asking the companies, when do you think your earnings environment would bottom out and demand would, gradually begin to come back? And almost in each and every quarter over the last 2 or 3 quarters, I'm seeing that it's going to happen in the next 2 quarters. And that timeline keeps on shifting. So that would be clearly one sector where I would expect earnings estimates to come down further. Second, IT services. Even though services sector has not been hit by the Trump tariffs, there is a clear wait and watch environment among the U.S. corporate investments. So investors or rather the corporates are not really willing to invest more in either capacity expansion or improving productivity through tech investments. And that's not good news for IT service companies. As these results come out, as we get more and more commentaries from the IT companies, I would almost certainly see another leg down in their EPS estimates. I would think that even some of the domestic sectors like industrials, consumer discretionaries, you would have earnings estimate downgrades, partly because those earnings estimates have not been downgraded to the full extent that they deserve. But honestly, I think the domestic sectors are possibly close to the end of their earnings estimate downgrade cycle. Now we have to be more careful about the globally linked sectors like IT, like metals, like some of the pharmaceutical companies and so on.
Just to recap that, Manishi, so you're saying downgrades in IT and in consumer discretionary, those are the big ones.
Right.
Where else will you see, or are you expecting big downgrades?
I would expect some of the other globally linked sectors also, let's say metals or other materials. So these 3 or 4 sectors put together is almost about 40% of the total Indian earnings, the earnings profile. So that is, those are the sectors that I would be more concerned with.
And do you feel that this reality of lower earnings, do you feel that it's not adequately reflected in stock prices in the market level right now? So there's a downside risk to the market. Is that what you're saying?
Yep. In fact, as I said, that if you look at the consensus estimates for the market as a whole, for most of the aggregators, it is turning out to be about 15 to 16% for both fiscal 26 and fiscal 27. I would expect at least the fiscal 26 number to come down to just low teens or early double digits.
Okay, all right, Manishi, appreciate you joining, and thanks a lot for giving us your view on the markets. We look forward to having a longer chat with you in the next couple of weeks.